Well, let me give you guys the scoop what's going on right now. So we were gassing up the Rockets last night, right, on the stream. Loading up fuel, and fucking shorts come in and put C4 in that bitch. Blew the whole thing up. Pretty much what's going on today. There's still bullish sentiment, and you're still seeing people coming in and buying the stock. We are only up about 1%, but the markets are down quite substantially today. We got some bad news for the broad markets. We got the jobs report that came out. We have Fed Daly speaking. We also have Biden, young Biden, coming out and speaking here any second now. So markets are kind of anticipating young Biden, jobs report, Daly, the Federal Reserve, all of these things at a very unfortunate time where AMC had finally gotten some good news. So we're going to go over what the situation is, what the data looks like, what the bad news is, all of that shit. But first, this is brought to you by AMC Appetite. You can see, look at this.
Come on, say the hip hop, the hip it to the hip hip hop, you don't stop the rocket to the bang bang boogie, say up jump the boogie to the rhythm of the.
That's fire. What? All right. Enough fooling around. Let's get into what is going on today. So the biggest thing that's upsetting markets, which is playing directly into what is happening with AMC, that's why it's important to cover here in these videos, is the jobs report, the non-farm payrolls. So hiring falters in December as payrolls rise only 199,000 though the unemployment rate fell to 3.9%. Non-farm payrolls rose by 199,000 in December, far fewer than the 422,000 estimate. The unemployment rate dropped to 3.9%, better than the 4.1% estimate. Wages increased more than expected, rising 4.7% year over year. Leisure and hospitality showed the biggest gain by industry. So let's break this down, because you guys are probably like, hey, that sounds good, right? Unemployment fell. Well, that's the positive. The unemployment rate fell, right? Non-farm payrolls only rose, not even half of what they were expected to. Now, let me be very clear. Before the Fed had come out and said they're going to start raising interest rates, become super hawkish on the markets, basically fuck the markets, right? This would have been good because investors would have seen it like, hey, the Fed's not going to come out and be super hawkish. But now investors are pretty much pricing in a guaranteed hawkish Fed, raising interest rates 3 times in a year, depleting their balance sheet, making the 10-year treasury yield go up, which makes all of your loans go up. Your interest rates, loans become more expensive. And now that we're not seeing the numbers here that are meeting expectations, that is being a far worse catalyst than it would have. Because the last thing you want is the Fed tightening and basically making capital more expensive to get your hands on, and the economy slowing down or not growing at the pace of what it's expected to grow at. So that's why that is really bad in a nutshell. And then wages increasing, not good at all, because wages going up means there is a chance to see more inflation. As people are paid more, they can afford, higher dollar items, right? If Chipotle or whatever, McDonald's is paying $15 an hour to all their employees everywhere, then they might have to raise a McDouble 50 more cents, So take it for what it is. That's what's beating down the markets today. When I say beating down the markets, I mean beating down the markets. S&P down 0.5%, NASDAQ down 1.15%, the Russell 2000 down almost 1%, VIX is up 4.33%, and the Dow Jones is down 0.23%. So that's the big thing that is faltering markets today, that is fucking us over, essentially. Now, on top of that, we do have right now Mary C. Daly. She's the president of the Federal Reserve Bank of San Francisco from 2018 until now. She is speaking right now about the balance sheet, raising rates, the economy, and sounding pretty hawkish. And hawkish, if you don't know, hawkish is like negative to the economy. Like, we need to raise interest rates. We need to start tapering as fast as possible. That's hawkish. Dovish is like, yeah, we can wait and see what's going to happen. We don't think, we're going to have to do that or this. Hopefully that makes some sense to you guys. Very important. You hear hawkish and dovish pretty much everywhere you go in the markets. Now, we also do have, which this is going to be an upcoming catalyst, we do have Treasury, Fed Jerome Powell, that is going to be testifying Tuesday, January 11th. So that's going to be after the weekend on Tuesday. And that could definitely move the markets depending what he says to Congress. So keep that in mind. But the biggest thing that is obviously hurting the markets today as well, one of the biggest things is going to be the U.S. 10-year Treasury yield. It's going up yet again. So we are on a straight rocket ship to the moon. Shorts did not plant C4 in the rocket ship's fuel. So, not good. If we really start to break out past this level, which we are at right now, and we are slightly actually above that, but if we start to get more steam to the upside, that's not going to be good. And you're going to see markets freak out even more. What's going to be ultimately even worse than all of this, combine the fact if companies start to miss on their earnings. That's going to be very key. If companies come out and are missing left and right, this will be a quarter you will not forget. There will be a lot of pain. And I'm going to tell you that right up front. I don't think companies are going to miss in a dramatic way, though. So nothing I would worry about too much, but definitely to keep in the back of your mind. AMC is going to be very explosive today, though. It wouldn't surprise me if we did rally and close up 5% or more on the day if the markets do turn around after young Biden does do his speech. Now, we did hit that low at $22.48 per share. We're still in the danger zone. We're only about 30 cents from the bottom right now. We did hit a high of $24.30 per share, and we did see this double bottom form yesterday, where we did hit the exact same cent low that we did hit December 14th, $20.80 per share. Yesterday hit $20.80 per share. Thank you, trading algorithms. You make it really easy to see what's going on. So with that being said, last time we did hit this level, we did rally and seen a very strong move over a $12 move round trip from bottom to the top. So if that happens again, that would put us back to the low 30s, up to about $32 per share. Really what we need to watch for is a break above the 20-day simple moving average at $26.56 per share. So that's going to be very key. It's looking very good. The double bottom pattern, if you don't know what that is bullish. That signals a reversal. A possible reversal is coming. It's not always going to work, but it's a very strong technical factor of trying to predict a reversal. MACD, bearish, definitely bearish, starting to go even more bearish, which is not good, but definitely expected overall. And then watch the 200-day moving average, which is at about $33.33 per share. Now, let's get into the Ortex data. Refresh the page, see what we're looking at, and shorts are going to town today. We're looking at 17.46% short interest of free float. Borrowed shares 567.9 thousand. Cost to borrow max staying about the same at 1.56%. Share utilization at 75.58%. Days to cover at 2.45, staying relatively unchanged, kind of starting to tick up a little bit. And this is still, you're waiting for that divergence for the share price to shoot up and the days to cover to shoot down. And the way we look right here, and with all of this other data, we're going to go a lot higher than June. People, say this was a short squeeze. This was not a short squeeze back in June. The short interest only went down 5%, or in other words, 25% of the short sellers covered in June. And that first 25% is going to do the least amount of damage. If shorts were forced to keep covering up here at the $70 range, that other 75% of short sellers would have took a massive beating, and that would have jumped the price up even more to the mid hundreds, 200s, 300s, 400s, 500s. You get the idea. That's the scoop on that. As far as the option activity, Not seeing too much at all. You're definitely seeing the calls increase on the out of the money side. If we do, for whatever reason, see a bounce by the end of the day, that could be substantial. As you know, same theory goes, we have a lot of calls that are out of the money, and we do have a lot of puts that are in the money, potentially two forms of buying power that are going to come if the price of the stock does start to go up. As far as the max pain, if you do not know what that is, explain it like a 5-year-old to you guys real quick. It's basically where the options holders will lose the most amount of money, like option sellers, holders, where everybody gets fucked the most, basically. And the max pain's at $25 per share. The market makers try to pin it around that price each and every week. So if that's $25 per share, we're currently trading at $22.62. That would suggest about a $2.50 move to the upside by the end of the day. That's about a 10% move. So take it for what it is. If the markets turn around, it's most certainly possible. So that is going to do it for this video. Not too much else to actually add. We're just going to have to wait and see what happens. Overall, with the markets being this fearful, not a terrible day for AMC. It could get a lot better, though, by the end of the day. So hit that like button for me. Consider subscribing to the channel. Check out the link down below for the buy and sell alerts. Even though the markets have been selling off, we have been killing it. So if you guys want access to all of those trades, check that out. If you want to support the channel as well, linked for Public, link for Weeble, link for Mumu as well in the description of this video. Love and appreciate you guys. Thank you for watching. I will see you in the next one.